For decades, treasuries were regarded as the most reliable gold standard in world banking. However, a surge of bond sales from 16 ally countries, including Japan, Saudi Arabia, and even the United Kingdom, implies that Washington's long-standing trustworthiness may be called into doubt. Some wonder if the world's largest economy, the petrodollar system's champion, is about to experience a rupture that seemed impossible only a few years ago. Could this be the first serious indication that America's unrivaled energy and financial strength are approaching a new era? Interest rates are rising, the U.S. public debt is increasing, and friends who were previously satisfied to keep massive amounts of U.S. assets appear to be turning abroad for safer or more profitable options. Is this simply a reaction to short-term market volatility or the start of a larger shift away from the dollar-based system? As Washington strives to project confidence, the allure of alternative reserves such as gold, yuan, and even cryptocurrency is gaining traction throughout the world. Saudi Arabia's shift toward China, Japan's portfolio realignment, and the United Kingdom's post-Brexit financial strategy are all intertwined, creating a complicated threat to American hegemony. The issue is whether these bond sales will trigger a true crisis, lowering America's borrowing rates and creating concern well beyond its boundaries. Let's take a look behind the scenes at this remarkable development. For years, the U.S. Treasury was regarded as the world's safest sanctuary. Allied countries like Japan, Saudi Arabia, and the United Kingdom were holding large quantities of U.S. bonds to secure their reserves and enhance their strategic connection with the U.S. However, new data released in recent months has turned this image upside down. While Japan's bond supply is quickly falling, Saudi Arabia is reportedly selling off its bond holdings due to political concerns with the United States. A similar trend exists even among close friends, like in the United Kingdom. What are the reasons for the sell-off? The first thing that springs to mind is the U.S.'s rising fiscal deficit and massive public debt load. The long-discussed question of the trustworthiness of U.S. Treasury bonds is back on the agenda. According to some analysts, the value of bonds decreases when interest rates rise. Thus, nations do not want to risk losing money. Others warn that faith in the U.S. dollar system is eroding, and the world is seeking fresh reserves. There have even been suggestions that Saudi Arabia is questioning the petrodollar system. So, how does the Federal Reserve's high interest rate policy affect bond stocks? As the Federal Reserve worked to control inflation by hiking interest rates, the dollar was projected to increase versus other currencies. However, decreasing bond prices may render this strengthening undesirable. Higher interest rates have a detrimental impact on the price of existing bond stocks, even if the nominal return on bonds rises. Investors who perceive losses rather than gains in the near term believe that if the situation persists, it is advisable to sell their bonds and go elsewhere. In several nations, conversations about transitioning to non-dollar assets are ongoing. Gold purchases, UN reserves, and even cryptocurrency assets have all become part of the equation. These worries are increasingly evolving into actionable initiatives. The collective bond sale of 16 allied countries produced a sense of dread in the United States. The collective bond sale suggests an economic and diplomatic snowball effect. If a wave of sales begins in one country and spreads to others, the cost of borrowing in the United States would skyrocket, potentially precipitating a public sector budget crisis. From the outside, many argue that the United States is still the world's reserve currency, and no one can entirely abandon it. However, concerns such as the U.S. debt ceiling battle between 2023 and 2025, the Biden administration's expenditures, and Washington's unpredictable foreign policy are causing mistrust among friends. No one is as comfortable as they were before because the premise that America is always a safe haven has been challenged. How about the political dimension? Saudi Arabia viewed its bond holdings as strategic leverage due to its long-standing oil-dollar tie with the U.S. Recent tensions between Riyadh and Washington, notably over OPEC+ policy, human rights concerns, and regional crises, have pushed the Saudis to distance themselves from the U.S. Not just in Saudi Arabia, but also in Gulf nations like the United Arab Emirates and Qatar, there is a growing consensus that we should work more closely with China and Russia. This demonstrates that dollar bonds are not as necessary as they once were. On the Japanese front, the dynamics are radically different. For a long time, Japan was the largest purchaser of U.S. bonds. Even when the value of the Japanese yen fell, the Japanese government bought in U.S. Treasury bonds. However, revived economic policies, higher defense expenditure, and increasing interest rates may have prompted the Tokyo government to cut its bond holdings. Furthermore, the United States' aggressive China policy in the Asia-Pacific is straining regional balances. Japan is, of course, one of the United States' most important friends, but it may be shifting to a policy of diversifying its portfolio. Let us not simply pile up on U.S. bonds. This raises the question of whether Japan made this move merely for economic reasons or to convey a political statement. The fact that the United Kingdom is one of the 16 allies prompts jokes about how even its own mother has abandoned it. The London government, which has long cooperated with the United States within the framework of special ties, is attempting to expand and diversify its own financial center in the post-Brexit future. As a result, it may decide to sell its bonds, diversify its foreign exchange holdings, and pursue other investment opportunities. Some observers believe this is due to economic realities rather than the UK's faith in the US. Others believe that, in the grand scheme of things, Europe and the United Kingdom are no longer as reliant on US global leadership as they were previously. All of these occurrences raise the question of how Washington will react. The U.S. Treasury Department calls for caution, saying, "We still have the deepest and most liquid bond market in the world, and small fluctuations are normal. But it remains to be seen whether the 16 countries simultaneously starting to divest is a minor fluctuation or a precursor to a major earthquake." Of course, they are not all performing a coordinated operation. Every country has its own motives. Nonetheless, the coincidence of time is resulting in a tsunami of cumulative bond sales. There is fear in the stock market. Will a fresh crisis emerge if interest rates in the United States rise? If U.S. interest rates rise fast, developing nations that rely on dollar funding would suffer, and the chance of a worldwide recession will grow. In other words, there might be a chain reaction. Doesn't seem too promising, does it? Some analysts believe it is overstated to present a picture of a U.S. collapse. They say the dollar is still the world's primary reserve currency. The U.S. economy is massive. Its military and technological superiority persist. Of course, its bond position may drop due to cyclical factors, but no one will give up entirely. On the other hand, occurrences such as gold stockpiling by China and Russia, BRICS nations' efforts to construct a non-dollar payment system, and Gulf countries winking at UN-based oil sales keep the issue of whether the dollar era is coming to an end alive. Now that the 16th ally's problem has been added, warning bells are sounding much louder. The Biden administration, on the other hand, supports the Federal Reserve's efforts to reduce inflation while focusing on a stable economy and resolving the debt limit issue. But are allies exploring alternative solutions to the United States' financial crisis? In recent crises, the U.S. government has always argued that our debt is the safest harbor because we always repay it. However, domestic debt ceiling politics regularly devolved into a crisis, threatening a government shutdown and jeopardizing the country's credit rating. The rest of the world observed this domestic political drama with alarm. Now, several allies, ranging from Japan to Saudi Arabia, are considering developing a departure strategy. Yes, the United States' collapse may have been overblown, but depending only on dollar bonds may no longer be as appealing as it once was. Finally, let us consider geopolitical factors. Saudi Arabia is developing energy arrangements with China, and petroleum rumors are spreading. Despite its differences with China, Japan is economically dependent on the vast Chinese market. Europe, on the other hand, seeks long-term strategic autonomy, even if energy challenges and the war in Ukraine appear to be forcing it to align with the United States. Britain is seeking its post-Brexit identity. This image leads to the conclusion that the United States remains powerful around the globe but is not as dominant as it once was. Bond sales are the financial representation of this image. Isn't this a multi-dimensional chess game? How do you see these developments? Are bond sales by countries that the U.S. considers close friends truly the sound of a big collapse? Or are they just the outcome of interest rate and market fluctuations? Is there an alternative to the dollar? Or will the reserve currency's throne be rattled but not overturned? Some argue that a country with that much debt cannot be trusted permanently, and that the world must adopt a new system. Others argue that there is no reason to fear. America will recover. What are your thoughts? We look forward to hearing your feedback in the comments. Please remember to subscribe to our channel, enable alerts, and press the like button. Goodbye for now, but keep an eye and ear out for us.